IVM.
If you're someone who struggles with keeping track of the balance in multiple accounts, I have an easy solution for you. Get the Jupiter Digital Banking app. You can connect multiple accounts on Jupiter Money and view all of it in one place with their new Net Worth feature. They also have another fantastic feature called Debt Tracker, which helps you track all of your loans on Jupiter and also sends you reminders for loan payments. It's quite simple, a banking app that helps you master your money. Check jupiter.money to find out more or download the Jupiter app on your Android or iOS phone and get started. Folks, welcome to Paisa Vaisa. I'm your host Anupam Gupta, B50 on Twitter, and on today's episode, we have India's first financial website straight back from the 90s, Equitymaster. Check out equitymaster.com. And my guest is Rahul Shah, co-head of research, Equitymaster. We're going to talk about what's happening in the markets, what's their outlook on the markets, how you should do equity research, some important tips for you, and much more right after this short break.
Love fighting?
We've got you covered.
Check out our show, The Fighting Goat, where we, the voices of the internet, Arjun Chipalkatti and Somesh Kamra, bring to you crazy weekly action on your favorite combat show, The Fighting Goat.
Be it commentary, breakdown, predictions, analysis of styles and techniques.
And of course, your round of favorite fighters.
You can listen to us every Thursday on the IBM Podcast app, website, and all major podcast streaming platforms.
And welcome back. Rahul, welcome to Paisa Vaisa. Thank you so much for doing this for our listeners.
Thank you, Anupam. It's a pleasure being here.
So tell us about equitymaster.com. Some of our listeners might not have heard about it. It's among the oldest, most respected website when it comes to, like the name says, Equitymaster. Tell us about it.
Yeah, so Equitymaster was, I think, founded back in 1996. As you rightly said, it was one of India's first independent research houses. And I'm proud of the fact that we managed to survive in this cutthroat industry for more than 25 years now, and that too on a subscription-based business model, which is difficult. I think the key to our success is we've not been afraid to call a spade when the situation calls for it. I guess historically also, we've not been hesitant to go against the crowd. A striking example of that is back in 2007-2008 when Reliance Power IPO came. I think it was the talk of the town. Everyone was, willing to subscribe to it, and there was huge frenzy around it. But when we did our numbers, we realized that the risk reward ratio is not in favor of investors, and we were amongst the few research houses that gave an avoid on the issue because we felt that the valuations were expensive and there was not enough money being left on the table for investors. So that's a contrarian call right there. And recently also we've again managed to take contrarian calls on IPOs like Paytm and Zomato. These companies, again, we felt that, the risk reward was not in favor of investors. There was not enough money being left on the table for investors. So it is these kind of contrarian calls that have endeared us to our subscribers. And that's one of the reasons we've been able to, survive for so long. Of course, we've had our share of, mistakes. It's not that we've been right all along. We've had wrong calls as well. But I think as far as the intentions behind those calls are honest and are unbiased, subscribers, sort of forgive you for that. They like to listen to someone who's unbiased and who's honest. And this is what we've done historically over the years, and we would like to continue to do in the future as well.
Yeah, I'm sure you will. Tell us about independence and unbiased, right? That's important for people when they get their advice from somebody. Why, and Equitymaster is both of that. Tell us something about that.
So yeah, you see, I think it was the legendary Jeff Bezos who once said that you should have a business model around things. You should have a strategy around things that are not likely to change in 5, 10, or even 50 years from now. And as far as research is concerned, people, there are timeless ideas like honesty and impartiality that you should give to your readers. You should have a win-win business model where you benefit and the subscribers also benefit. A lot of the business models in the industry out there are not win-win. There's a huge conflict of interest out there. So we work towards removing that conflict of interest. We've tried to make it a win-win for both us and our subscribers, and it has, worked for us.
Yeah, and we know about how the conflict of interest arises, at least with the interested parties, pump and dump schemes and all that.
Absolutely.
We'll just spend 5 minutes so that our listeners know that what they should be cautious about when they're getting into this kind of stuff.
Absolutely.
So how does that work? I mean, if someone offers you advice what's a good way to know that it's biased, or when you know it कि अच्छा इसमें कुछ तो झोल है boss, when someone is saying buy XYZ, how does one identify that?
I think this business, the business of investing, is all about trying to find the intrinsic value of a company. And you have to be willing to take, as I said earlier, willing to go out and give an unbiased opinion. You have to do your research, to be honest.
Research. So that's really important, Rahul. Tell us about equity research, the process. Maybe there are some listeners out there who want to do their own research. What does it take? And typically, what's a good research process to follow when you're analyzing a stock or a sector? Where do you start, for example?
So I think a very important saying in our field is investing is most sensible when it is most business-like. So this is something that legends like Warren Buffett, legends like Peter Lynch, have Charlie Munger have followed. Even Ben Graham used to subscribe to this principle that when you're investing, it is very important to have a business-like approach to investing. You should invest from the point of view that you are investing in a real business. And when you invest in a real business, the most important thing is you should be able to value the business. So I think if I were to give you a one-line answer of what research is all about, it is to find the intrinsic value of the business. Now, what I mean by this is, say there's a stock out there, Tata Motors. It's currently trading at around 420, 430 rupees per share. Should you buy or should you not buy the stock? That all depends on the intrinsic value of the company. The company, based on its past history, based on its future prospects, has a certain earnings capacity. It has a certain earnings power. And based on that earnings power, you're supposed to value the company. So if I do my research on the company, if I look at the past history of the company, if I look at the future prospects, and I realize that the company is worth 500 rupees per share, so that's the value of the company. And since the price of the company is lower than the value, it's a good buy right now. If you do your research, if you figure out that the company is worth only rupees 350 per share, which means that the company is expensive. So research at the end of the day is all about finding the true intrinsic value of the company. And once you do that, then you're taking an informed decision on the company. So the entire research process is around that one thing of that one idea of finding the intrinsic value.
Great. You're also the editor of Microcap Millionaires.
That's correct.
So that's a newsletter, right?
It's a recommendation service.
It's a recommendation service. What are microcaps? I mean, let's just spend some time out there, because there's always something so alluring about finding a stock when it is of a lower market cap, lower valuation, and then riding it all throughout. Like you said, you find out that the intrinsic value of a stock is maybe 10, and you can see that the future value of it could be 100, and that's like a 10 bagger. Let's talk about microcaps for some time.
So microcaps, typically, of course, there is no universally acceptable definition of a microcap. A microcap for me personally is a company which has a revenue of at least rupees 200 crores. And it's a fundamentally strong company. It has a decent history going back 5 to 7 years. And plus, it should not be a large company. It should not be covered by a lot of analysts. Microcap stocks, the reason I love microcap stocks is because there is this information asymmetry that you can take advantage of when you're investing in microcaps. Now, what I mean by this is, there are large companies like TCS and Infosys. Imagine these companies announce record-breaking profits. And because of these record-breaking profits, you have to upgrade the share price of the company. Now, the moment these companies announce the record-breaking profits, there'll be hundreds of analysts covering the stock. They'll come out with a report on the stock. And suppose the price of the stock is rupees 1,000. Because of these profits, the stock price has to now be taken upwards to rupees 1,200 rupees. Yeah. So that opportunity is not going to be there for a very long period. The day company announces record-breaking profits, next day or in a couple of days, the price will shoot up to rupees 1,200, and that opportunity will be gone in a couple of days. If you consider similar example in case of microcaps, if a microcap announces record-breaking profits, if its price is rupees 100, and because of these profits that the company has made, if you think the company should deserve a price of rupees 150, that information asymmetry is going to remain. It's not going to go away because there are not a lot of analysts who covering that stock. So this is what I love about microcaps, that since not a lot of analysts cover the stock, there's always this information asymmetry where there's something positive that happens around the company, but the market is late in reacting to it. So you, time and again, if you do your homework on these microcaps, if you keep a close watch on these microcaps, you can take advantage of these information asymmetries. But of course, it's also a double-edged sword because microcaps are inherently risky. If you're not doing your homework right, you can lose a lot of money as well. But net, I think it's a good space to be in if you know the kind of companies that you're looking at, and if you keep a close watch on this space.
So let's talk about homework out here. Let's talk about the kind of research process, because like you said, this is a minefield. The thing with microcaps, I'm sure that even you would know, is that you might have some unscrupulous promoters who like to, skyrocket the share price, and people and retail investors are kind of left behind in that. Maybe the fundamentals are actually good, maybe they're not good. It doesn't take much to start a rumor in the market. So maybe some tips or some pointers to our listeners out here as to what is the kind of homework you have to do when it comes to microcaps.
I think one of the big reasons people lose money in microcaps is they pay a lot of attention to the future potential and pay very little attention to the historical performance of the company. If you have to choose between two companies, company A, which has a shady past but which is expected to do big things in the future, and the share price is likely to go up 4-5 times, versus company B, which has a decent financial history. The management has been good, the balance sheet has been strong, but the growth potential is not that much. I'll always ask subscribers to choose company B because the past performance of the company has been great. It has proven itself, whereas the first company does not have a sustainable business model because it's loss making. Just because its future is supposed to be bright, you should not buy that story, in my opinion. You should always stick to the tried and tested companies when it comes to the microcap space. Companies with the proven track record, with decent management, with strong balance sheets is the kind of companies that you should choose, in my view.
Strong balance sheets. So that's important, right? I mean, I would say any equity research should begin from the annual reports. Do you think that's right?
Absolutely. Yeah.
So you should be looking at last 5 years annual reports, dig down into that, look at what kind of ratios or trends or what kind of analysis would you do?
So if I were to give you some broad numbers, what I typically look at is companies should have at least a history of 7 to 10 years. With maybe 1 or 2 years, I'll accept if the company is loss making for a couple of years. Beyond that, I will not, consider the company. So over the last 10 years, if it's been loss making for one or 2 years, that's fine. It should largely be profit making, and it should have some kind of growth. I'm not saying that very high growth. Even if the growth is in the range of 7-10%, that's fine by me. And the most important thing is seeking a margin of safety in valuations. When you're investing in a microcap, if you think the company is worth 120 rupees, do not buy it at more than 90 to 100 rupees. You should keep that big gap because microcap companies are risky. They do not have resilient business models. So in order to save yourself from big capital loss, you should insist on a big margin of safety. So for a large cap like say TCS or Infosys or any other company, the margin of safety, even if it's to the extent of 15-20%, is fine. Yeah. But for a microcap, I think you should keep a larger buffer, have a margin of safety of at least 40-50%.
And do you think that in this market or throughout your career, you've seen plenty of such examples?
Yeah, but they tend to come in bunches. There will be periods when large number of decent quality microcaps will be available at throwaway valuations, and there will be periods where you have to be careful. You have to be careful in the sense that even if the microcap companies that are available and they appear cheap, they could be value traps. So this is a very important point that you should keep in mind. When the markets are attractive, when the markets are down, there will be a large number of companies which are good companies that you can buy. But when the markets are near their all-time highs, then you should be careful while investing in microcaps, because just as they go up the most during a bull market, they also fall the most during a bear market. So when you are at the top of a bull market, you should be careful of investing in microcaps.
What are some warnings out here? Like, would you, because this is the era of social media, you never know, if somebody wants to, as they say, chala हुआ stock, तो कुछ बोल देंगे Twitter पे यहाँ वहाँ पे. You think there are some red flags that one should be careful of?
So what I have usually done is I don't invest in microcaps unless they are available in single digit or low double digit price to earnings ratios or below book value. Once you do that, I think you've taken care of a large number of value traps. I do not look at companies which have a balance sheet of anywhere between a debt to equity ratio of anywhere between of more than 0.5 times. So these are the 2-3 important things that you should always keep in mind. Even if a good microcap is available at a price to earnings multiple of 20-25 times, I will not touch it because I need that big margin of safety. So you should be mindful of the valuations that you're paying, the balance sheet of the company, and the financial history of the company. These 3 things I think are very, very important.
Yeah, folks. So that's just minimum 3 things. If I make a list, that's probably 10-20 things. So these are just some very basic pointers for you to keep in mind when you're doing research on a microcap. Please don't consider this as specific investment advice. For that, you should subscribe to Equitymaster.com. And Rahul spoke about how microcap prices move in a certain, all of them move together, or there are some periods of up and down. We're going to talk about exactly those periods in the market, what's happened in the market in these last couple of years, and what's Rahul's outlook for the future, right after this short break.
Hey, it's been another great week on the IVM Podcast Network. On The Habit Coach, Ashton talks to Avantika Sinha, managing partner, leadership trainer, and coach at Stillwater Consulting. She shares 5 key mindsets that we all must imbibe in ourselves. The Simplified Gang look into the European Union's recent regulations to rein in tech companies. On the Filter Coffee Podcast, Karthik speaks with author Vasanthi about her new book, Ganga's Choice. On the Life Manifesto, Zarina decodes 7 overrated concepts that we must do away with. And on Football Twaddle, Saru and Yash discuss how Arsenal always disappoints in the season. Do follow us on social media. We're IVM Podcast on Twitter, Facebook, Instagram, and LinkedIn. And remember, if you're enjoying this show or any of our other shows for that matter, please do tell a friend. Also, please don't forget to rate us on any of the platforms you're listening to us on. And remember, you can always check us out on YouTube. We have a number of channels. You can go to ivmpodcast.com/YouTube to take a look at what those channels are. We're also doing a small listener survey to understand how you respond to our shows and the advertising on the network. We would really appreciate it if you could spare a few minutes to fill it out. It really helps us build better shows for you and understand what you're looking for from advertising and what we can talk to advertisers about who you are. Please go to ivmpodcast.com/survey. It really would help us out. Thank you so much. And finally, would like to thank our sponsors for the network this week, SBI Life Insurance, India Water Portal, and Jupiter, a digital banking app. Thank you so much for making this possible.
And welcome back. Now let's make some sense of what's happened in the broader markets in these last 2 years. Ever since the pandemic started in March 2020, you had the markets dip by 40%. Nifty was really sharply down. Then you had this big move up. And now I think, let's hope that the pandemic is over, or at least at the last stages. I want to get into this discussion on the markets in 2 questions. One is the past and one is the future. So let's just try and make sense of this past that's happened, because every year there's some new dhamaka. First you had the pandemic, then you had the second wave. This year you've got a war. So tell us about that.
So I think there are different approaches to investing in the market. As they say, there are different ways to skin the cat, investing cat. My approach is based on my own experience in the stock market. I've been in the market for more than 15-16 years now. And what I've realized that absolutely no one has any idea what's going to happen in the market 1 to 2 years down the line. And secondly is you should always be prepared for a large and disturbing decline in the stock market and sometime in the near future. That's almost certain. Every few years there's going to be a big crash in the market. Plus, no one has any idea of what the market is going to do. And when you have these 2 principles, what is the strategy that you should adopt? So the strategy that I adopt is, since I know that there's going to be a crash in the market, anytime in the future, and I don't know the timing of it. So what I do is, if I have 100 rupees, I keep 25 rupees in bonds or in fixed deposit. And since, a crash can take a long time to come, it may not come for the next 3-5 years. So I keep another 25 rupees in stocks at all times. So this allocation is sacrosanct. I do not change it. 25 rupees in stocks at all times, 25 rupees in bonds or fixed deposits at all times. Remaining 50%, I play depending on the market valuations. So if I were to give you an example, back in January 2020, when the market was at its peak, it touched 40,000. I had asked my subscribers to be 75% in cash and only 25% in stocks because the markets were expensive from a price to earnings multiple perspective. This gave us fantastic opportunity to invest in bargains when the 40% crash came because of the coronavirus pandemic. So in April, May period onwards, I had recommended my subscribers to increase allocation to stocks because the markets had become attractive. Then again, it went up one way till Diwali of 21, I think October, November 21. Then when I looked at the valuations, I again saw that the markets are expensive. So I asked my subscribers now to pare down exposure to stocks. So I asked them to bring it down to 50-50, 50% stocks, 50% cash. And this has been my strategy all through. Periodically, you look at the stock market valuations and then you change the allocation, toggle between stocks and bonds based on the broader stock market valuation. And the beauty of this approach is, the number one mistake that people make when investing in stocks, they take a large exposure to stocks when the stock markets are up all-time high. And they get scared or they panic when the markets, fall 20-30% and they move money out of the stocks. Sensible investing will ask you to do the exact opposite. When markets are down, you should pump more money into stocks. And when markets are up, you should, take money off the table. So what this strategy does is it allows me to do this right thing from a long-term perspective. And I think it's a very sensible strategy for any retail investor to follow. And it does away with all the jhanjat of, trying to time the market, trying to use understand what kind of macro event is going to cause what kind of damage to the stock market. So this approach of toggling between stocks and bonds based on broader market valuation, I think, is a very effective approach in my view.
So, okay, Rahul, let's talk a bit about positioning in this market. How do you approach the markets, when it comes to things like asset allocation and figuring out how much to put in the market, cash versus positions? Let's talk about that.
So it's not a positioning for the next 2-3 years. I think you should look at your allocation once every 6 months or 1 year. So for the next 6 months at least, I'll be 50-50 between stocks and bonds. The markets are expensive. I think on the Sensex, we are at a PE of around 23-24 times. Which is expensive, but not that expensive, crazily expensive. Long-term average is around 20-21 times. So it's just 5-10% expensive. So this, I think, is a good time to 50% in both in stocks as well as bonds. And I'd like to keep it this way at least for the next 6 to 9 months, and then maybe take a call based on where the markets are.
Okay, so for someone who's absolutely brand new to markets, that's a recommendation as of now. My question to you is, first, what would be your advice to someone who's investing in equities for the very first time? What are maybe a few pointers for him to know about himself or about the markets before investing and jumping in?
So I'd once again go to Warren Buffett. He's often heard saying that if he were to take a finance course, investing course, if he were to teach an investing course, it will have only 2 lessons.
Okay.
And these lessons are how to think about market prices and how to value companies. And I think I can't agree with him more. The famous analogy of Mr. Market that he often gives, Mr. Market is this moody fellow which will give you prices from time to time. When he's sad, when he's depressed, he'll give you very low prices, and you should be greedy when Mr. Market is fearful, and you should be fearful when Mr. Market is greedy. So back in, again, go back to Jan 2020, Mr. Market was quite greedy. So it was time to be fearful and, sell to Mr. Market, sell stocks to Mr. Market. When the markets fell 35-40% after the coronavirus pandemic, Mr. Market had become fearful. It was time for you to turn greedy and, buy stocks from Mr. Market. So you should always keep this in mind, the story of the fable of Mr. Market. So how to think about market prices, that's very important. And second is, of course, how to value businesses. You should start maybe with some basic book on valuation, and then it will come with experience, I guess. Valuing companies is not 100% science. It's also an art, and it will come with experience. But at least start valuing simple businesses. And as you understand investing more, and as you read more, your experience will grow, and then you'll be able to conduct more sophisticated valuations on companies. So these 2 things are very, very important.
Sure.
Know how stock prices behave in the market, how prices behave. That's very important. Second, you should know how to value companies.
Okay. Any favorite books or any, you spoke about Warren Buffett, you spoke about Charlie Munger, you spoke about Benjamin Graham. So any book recommendations for our listeners?
So in order to understand the nature of the beast, that is stock market, I would recommend Intelligent Invest. That's my all-time favorite book. It's not an easy read. It's a very heavy read, but you should try and read it. And when it comes to valuations, the book that has had the biggest influence on me is a book by a professor, Columbia Business School professor Bruce Greenwald. The title is Value Investing from Buffett and Beyond. It gives you a very simple and a very nice framework on how to value companies. So this is the book I would recommend to any beginner.
Sure. There you go, folks. So that's those 2 very good book recommendations. Last question, Rahul. You've written about EQ over IQ while choosing stocks. And I think I kind of get what you're talking about, because EQ is emotional quotient and IQ is investing quotient, I guess. When we've spoken about a lot about numbers and valuations and annual reports and debt equities, what's EQ?
So I think this business is all about earning that alpha, right? I mean, even if you do nothing and invest in a passive fund, you will earn your 14-15% over the long term. Now, the entire business of investing is earning 2, 3 or 5% more than 15% in the stock market. Long term, if you earn 19-20% over 15-20 years, you'll be considered a god. Now, how do you earn those extra 4-5% returns? There are 3 ways of doing it. One is you work harder than everybody else, but that method is physically very, very exhausting. Peter Lynch, I know, was one of the hardest working fund managers ever, but he had to retire at 48-49 years of age because he was working very, very hard. Second is, if you want to outperform the market, you need to be smarter than all the other investors out there. You need to have that wisdom. You need to read a lot. And that's Warren Buffett and Charlie Munger playbook. I think those guys are full of wisdom. You listen to them for 1 hour and, you'll come up with, some earth-shattering insights. Yeah. The third approach is emotional. Have a strict discipline and a strict process and stick to it. And this is what emotional EQ is all about. It is often said that in the world of investing, it is not the smartest investors who, often end up outperforming the market. It is usually the investors who are emotionally very strong. They have a process and they stick to it come what may. And even Peter Lynch says that in the stock market, the most important organ in the body is not brain. It's your stomach, it's your gut. So the ability to keep your emotions under check, to have that emotional resilience is very, very important. Have a particular process, you stick to that process with a lot of discipline. That's the most important thing in investing, in my view. That's what EQ is all about.
And on that note of being disciplined in your investing, that is a wrap on this episode of Paisa Vaisa. My guest, Rahul Shah, co-head of research at Equitymaster. Rahul, thank you. Really, thank you so much for doing this for our listeners. And listeners, thank you so much for listening to this episode of Paisa Vaisa. If you like this podcast, don't forget to check out other interesting podcasts on the IVM network. You can listen to us on the IVM Podcast app or ivmpodcast.com. You can also follow us on our social media. We are IVM Podcast on Twitter and Instagram. And if you want to reach out to me, I'm your host, Anupam Gupta, B50 on Twitter. Folks, thank you. Thank you so much for listening to Paisa Vaisa.
No material on the show should be considered as financial advice. The material on the show is for informational purposes only. Please consult a financial advisor before taking any investment decision.
There's a quick survey to fill out on ivmpodcast.com/survey. It lets us know a little bit more about who's listening to us. And you know what? We're going to do a few prizes. So, we'll do a random drawing of maybe 10 people and we'll send you all some swag. Remember, that's ivmpodcast.com/survey where you can fill out the survey.
What is the workplace and how does your gender and body affect your right at work? Hey, I'm Priya Mirza, and on the Longest Constitution podcast, we critically examine the vision of the Indian Constitution and laws. In season 1, we looked at sex, gender, sexuality in India, and the landmark judgments which transformed our rights as citizens in this country. In season 2, we discussed the laws which shape the workplace and examine how ability, competence, and merit impact us, and much more. Join me, Priya Mirza, every Wednesday only on the IVM Podcast app, website, and all the major podcast streaming platforms.